Hi, welcome back to the Estate Planning Daily Show. Yesterday I spoke a little bit about step up in basis. Step up in basis is terminology in the estate planning field that talks about when someone dies, how all of their assets get a step up in basis to the fair market value at date of death. That means that regardless of what they paid for it, the cost to the beneficiaries or the heirs of that asset is the fair market value at date of death. For stocks, it's the average between the opening and the closing price of that stock on that day. If someone died on a weekend, it's the average between the opening and the close of the stock on the Friday or the Monday, and it's an averaging of those two amounts. With respect to real estate, the fair market value is determined based on an appraisal. You literally have to go out and get an appraisal of a home or other real property to determine the fair market value, and that appraisal will be evidence of the new cost to the heirs or the beneficiaries. With respect to community property, both halves, the husband and wives, get a step up in basis at death. In other words, if a husband dies, the wife's basis in all the community property assets will be the fair market value on date of death. It's true with respect to all assets except a few. And the few that it doesn't apply to are IRAs, installment notes, when people sell assets on the installment basis, and there's a few other assets, and those assets are called income in respect of a decedent, which means those assets don't get a step up in basis. The step up in basis is an attribute of death that is very positive, because any gain, any capital gain that was inherent in the assets, the underlying assets that the decedent owned, get a brand new tax basis at death, which means that the appreciation just evaporates, there's no capital gains on those assets, and step up in basis is a very good thing. Thank you for listening. Look forward to seeing you tomorrow. Have a great day.